Hey, this is Jeff Scott, and welcome to this week's weekend review. Um, HGSI Doc, that's me, and this is my top-down review. Will Tech EPS reports slay the bear? This is a review that's probably deeply entrenched in market review and less than me telling you what stocks to buy. Uh, we're going to bounce eventually. Maybe we bounce Tuesday or Wednesday, and I suspect when we bounce, the key will be that we bounced and rather than what the individual name is. But until we bounce, and if we bounce, there are bigger issues, and that's all about the market. For those who would like to reach me with any questions or comments, hgsidoc@gmail.com. I do these for free. I have nothing to sell you except an occasional live meeting. I don't sell indicators or anything like that. As always, it's for educational purposes only. I'm a doctor, not a broker. I'm independent, which means nobody pays me or gives me free things to say good things about them. Every tool I use at some point I paid for. And trading involves risk, and you alone are solely responsible for any decisions you make. From time to time, I'll talk about options. And if I talk about options, I want to remind you that people much smarter than I, such as the Options Industry Council, thinks that trading options are dangerous and risky, and I refer you to their and other websites for education before you stick your toes into the option market. I like to define my trading style as be your own guru. I don't create anything. I don't invent. Maybe a couple little things I've created or invented. Mostly I've modified, but rather I've tried to learn from smart people and put that to use in a way that makes sense to me. Um, this guy here in the upper left-hand corner, his name's Ian Woodward. May he rest in peace. What a brilliant and wonderful man. In his British accent, which I could never hope to duplicate, so I won't even try, he would say, Jeffrey, I am not the guru. I will teach you to be your own guru. And I think it's important that we all listen to those words and take responsibility for our own trading. I started with canceling like many others. How to make money in stocks. Yeah, it's a basic book today to me, but it's still something I go back and read. Morales and Catcher improved upon canceling, pocket pivots, diable gap ups, um, book on short selling. This is my buddy, George Lee. We've done a lot of programs together. I think we're going to do a couple days in Vegas in a couple of weeks for a very small group. Ron Brown, who started like I in the audience, but actually had the big win of being Ian's partner in Woodward and Brown Investing. So he got to spend a lot of time with Ian. Ron and I both use the tool. Ron and I think, are very aligned in our thoughts about markets and stocks. But we've got different styles where mine has evolved more to include some of John's and cigar stuff that I'll mention. Ron has become very much a volume spread analysis person. There are different strokes for different folks. It's how you make money. Doesn't matter what style you follow. If it works for you, that's great. And the cool thing is HGSI as a program supports both. Van Tharp, the king of position size and money management, I incorporate a lot of his ideals in my trading. Cigar from Superior Profit. New to many folks, he's active on our Discord site, as is Moxie Trader, TG. And they've both added some new things that help me make stock selections, new indicators. And then lastly, but perhaps as important as Ian to me, is John Person. John has been trading since I was in med school, has his own indicators, his own style, his own automatic trading, algo trading. He's an author, mentor, great teacher, and he really showed me how to take a list of stocks and turn them into profits. Now, speaking of learning, this is it, guys. I'm going to send out sometime midweek a follow-up to everybody that's paid, outlining the upcoming live seminars, which will probably start on the online versions in about 10 days. It's $500 whether you come live or not. For popular opinion, I added an online-only version. I am not promising to broadcast it. but I am promising to include you in all online events and to make sure within, say, 48 hours of the final program, I will post online the videos so that you will get everything I give away except for the food. So for $500, you're going to get a seminar, pre-seminar, 2 or 3 live sessions where I'll review my vocabulary, talk a little bit about options, and answer your questions. If the live seminar, 8 to 10 hours, I'll go over my basics of how I trade, how I apply those tools to a top-down approach, and then how I find my A trade, which is defined as the trades that, I'm most proud of, the trades that make me most money, like buying Tandem at 6, which I put on the board March 9th, or April 9th, rather. How I manage those trades, stops, position sizing, money management, how I use options. I am not an options guru. I'm not going to have a program called Jeffrey's Options Strategies. What I'm going to show you are 2 or 3 strategies that I make money with. I'm not a straddle, strangle, condor guy, butterfly guy. I'm a pretty simple guy. I like synthetic stocks. I like verticals, and I like buying and selling individual calls and puts. But we'll talk about that at the meeting. Earnings roulette. This is a big earnings week, but we'll talk a lot at the meeting about how I find trades like the January Netflix trade, and then putting it all together. Then we'll follow that with a post-seminar online, 2 or 3 events as needed to review, answer questions, and look at the markets. On the right, which you had a chance to look at, are some of the comments I've got from prior attendees, and I appreciate the positive comments. So what you'll get if you come live will be dinner and me Tuesday, either at my yacht or at a local steakhouse, breakfast, lunch, and snacks during the meeting, screencast videos of all presentations as well as PDFs, and then I share my non-copyrighted or patented indicators for TOS, TradeStation, and TC2000. Again, you can do this remotely and not attend the live Saturday session, Wednesday session, but you'll receive everything that everybody else receives, including complete videos. If something happens technically and the video comes out bad, I re-record them at my time so that you get a quality broadcast. We're talking about golf on Tuesday. We're still hoping to do that. Sometimes life gets in its way, but right now it looks okay. And if you're interested, I need to know quickly because I'm filling up. I need an email to me at hgsidoc@gmail.com telling me you want to come. If I prefer PayPal, using mdonk@mindspring.com for your $500. If for some reason, and I highly encourage it, you are attending John Persons as well, great presentations over 3 days, Thursday, Friday, Saturday, then I will rebate you $100 to use towards his as well. Hope to see you. As everybody knows, I have a lot of programs. I would never tell my wife how much money I've wasted buying stuff, because at the end of the day, I need TradeStation and Thinkorswim and specific indicators there. I need HGSI for my post-market analysis, EdgeRater, which helps me shorten my time. I do use some seasonality and some websites. HighGrowthStock.com, again, I have no direct affiliation. I get nothing if you sign up, except the gratitude of the proprietor, George Roberts. Free 30-day trial, no credit card required. Most importantly, under investing strategies, you'll find a list of videos and other entertainment from Ron, myself, and guests like Gil Morales. Patterns are cyclical. I'm a broken record, but it's really felt this year that we've bisected off the top and we get little runs. It feels like we're breaking out to nirvana and we fall back. It looks like we're going over the abyss and then we move up. Well, today is another one of those. Feels like we're in the abyss. I looked at hundreds of stock charts, probably 1,000 stock charts over the weekend. And to tell you that I found hundreds of good charts would be a lie. I found a lot of charts to short. And usually when I see a lot more shorts than buys, it's getting near the end of that move. And maybe we are going to get a leg up soon. So you got to adjust your approach. If I'm thinking that we're on this right shoulder here, that means I raise cash, have smaller and less positions, and sold premium. I've also bought some puts on my positions, sold some calls that are way out of the money. I am short a number of positions, and I bought contra ETFs or options on contra ETFs. Now, I am expecting us to hit a bottom soon. Doesn't mean we're going to. I again went into the weekend with a fairly significant protective set of positions. By that I mean long TZA, a inverse 3x to small stocks, long, yeah, excuse me, short triple Qs, which would mean I'm short the NASDAQ and technology. I am long nugget, so I'm long gold. I am short the diamonds, and I have a fairly substantial short position on the spiders. Now, that I also still have a lot of long-term longs in my longer-term portfolio, which I pinch my nose and ride out these corrections. But on some of them, I bought puts, and on others, I have trimmed my size. So I've got a lot of defensive things. If the market goes up 5% on Monday, I will be positive, but I will not be up as much as the market. If the market drops, I will probably break even um, because I've pretty much designed my protection to protect my nugget. So I'm giving up some upside to protect my downside. Friday sector review. You're looking at from high up here. Let's just look at it within TradeStation. And, you know, what do I see here? I know staples, which is this group here, have been strong. Utilities, which is this group here, have been strong. And real estate, perhaps because of their dividends this week, were strong. Some of the MLPs popped up as well. Materials were weak. Energy was weak. Financials seemed to strengthen, although it's hard to see that in my account where I have some financials. Industrials very weak, as was technology and discretionary. Healthcare, for the first time in a while, was weak. Communications and social strong, and I already mentioned real estate. So I look at that on a daily basis so that I can get an understanding, perhaps, of where I want to be in the market. Okay, now let's take a look at the markets in the Thinkorswim. Now, the S&P, the NASDAQ, actually those aren't what I thought I would look at. Let's go futures. I guess I killed the futures. All right, no worries. Let me fix that here. Let me pull up the futures so I'm consistent. All right, so in the upper left-hand corner will be the E-minis, then the NASDAQ 100 futures, then the Dow futures. Down here we have the Russell 2000 ETF, the VIX futures, and the dollar futures. And let's look at each thing with a year's worth of activity on the daily. And so, as you can see, E-minis ran up, set a new high back here in September, sold off since. And notice how they're bouncing here on the 200 as they did back here with earlier corrections this year. The NASDAQ 100s, very similar story. Big run up this year. Last closing high was, or high was back on October 1st, and now it's bouncing around the 200-day moving average. We look at the Dow futures, broken record. Guess what I'll say? It's been in a big uptrend this year. And let me max out the size. First set a high back in January, set new highs back in late September, early October, and now pulled back and bouncing on its 200. Now, those three all look like great opportunities to continue bouncing and then move up from there. Although the counter idea is what happened with the Russell, in which case it bounced early in the year in February and again in April off the 200. And here it knifed through, and it's got a lot of work to get back up there. Will the big three follow this one down, which will take us to a bear market, or will the big three bounce and pull the small stocks with it? I'll go in that category, but I'm not ignoring the first. The VIX popped here. The VIX futures at 24.2. I think the highest the VIX has been is about 28.8. And it's come down, but it's still significantly elevated. And the dollar has a new buy signal has popped up above its moving averages. If I quickly switch to a weekly review of this, see a few things that I'll add to that. you can see the big uptrends over the year on the major indices on the top. And that again, looking on the longer term charts, this looks like a very healthy pullback to the 50-week moving average. And even on the Russell, where it's broken through, you can see the great uptrend that it's had this year. You can see the VIX remains elevated, and the dollar had sold off hard. And this on the futures, which is different than the cash markets, they're trying to get above that 200-day moving average. Now let's go back to my PowerPoint. It's 9 o'clock in the morning, or almost 10 o'clock in the morning now, excuse me. So no shocker, there are not futures out yet for this coming week. I also like to look at my Genesis. This is not one that I put on must-have. It does have some nice scanning intraday and post-market. It's good for futures. But it allows me to have a daily, in the middle, weekly, and the bottom, monthly views. In the columns, I've got the E-minis, the NASDAQs, the Russell, NYSE, and the Dow futures. And I just noticed that we're starting to get a little junky with the new sell signals on the Russell and the NYSE on the monthly. So it just gives you an idea that over time, the dollar has, the daily has weakened, then the weekly, and now we're seeing weakness in the monthly. So this could be an argument that we still got more ways to go. Got some interesting analysis on this correction before I finish the PowerPoint. Rates rose again on both the 10-year and the 30-year this week. You can see the white turned up with the market turning down. High rates are supposed to be good for banks, especially regionals. Is this the week that regionals start to move? I saw a couple on my buy list, also supposedly good for insurers. As everybody knows, home builders are weak, although REITs did pop up this week, and utilities look good too, and I wonder how much of that is a defensive play. Here is the picture of the yield curve. So this blue, which is hard to see, is turned up a little bit. And everybody talks about the flattening of the rate curve. When it hits this flat line, it's flat. And it's popped up a little bit. So not a big signal there. The AD lines, which are in white, the S&Ps in yellow, just to show you on both the small stocks and the large stocks rolled over hard this week. And if you look here, the AD line on the NYSE in white, and then you've got the diamonds, the Qs, the spiders, the IDUM, and the transports have all dumped hard, as have the bonds. Breadth has dropped further this week and really is approaching oversold. Both stocks above the 200 and stocks above the 40 are getting to be the longest they have in the last couple of years. This is 2016, and these are the lowest lows since 2016. The 3-month new high, new low spiked off or popped off the bottom this week. Here was the prior week. So we're getting to that should reverse soon time, but there's no guarantees in this business. And what I want to show here, here's the McClellan. This is a daily, and just the idea how it bounced so many times off the 200-day moving average earlier in the year, and that's kind of what it's doing now. It did knife through occasionally. So this is very much reminiscent, and I'll show you some more data about that later. As I look at the daily summation index, we're getting to the point where you expect a bounce. The oscillator, not so much. The weekly, now we tighten things up, and you can see a similar pattern here. This is on the 50 weekly, and you can just see the bottoms here this week, this period, very similar to earlier this year. You can see some of the other pullbacks, and except for this one, which was a perfect V bottom, most of the bottoms have been complex, as we're dealing with here. Now, the summation index minus 2564, this is where it got to closer to minus 4,000 back in 2016. So we may have a little bit more damage before we get a signal there. Now, the buckets a week ago were extremely oversold. The buckets this week have come off that. It's still oversold with 82% of the stocks in the S&P 1500 below their lower Bollinger Band. But this was that Thursday I did that sort of emergency webinar, and we bounced a little bit, but then we gave it up. Will we bounce again? We're not totally oversold yet. There has not been a Hindenburg since beginning of the month. No surprise because you need new highs and new lows, and you can see on the NASDAQ on the left, the new highs are 0.2%. They're about 0.5% on the NYSE. Without at least 2.2% new highs, um, you're not going to get a Hindi, so that's out of the picture. Market tone actually softened this week. We had a good start of the week with a bunch of kahunas that flipped us from red to yellow and green. We're all yellow. I'd say we're neutral. And this here tells me the volatility is increasing. From a sector strength, about the same. Strong staples utilities down this week on energy. The rest were neutral. Now, the canaries in the coal mine, I know Priceline is now called bookings. It's reflected in the chart. These are the used to be the big leaders. They went sideways and they've fallen off a cliff. If I could short this, and I guess I can, there's ETFs. This looks very shortable here and weak. Now, many of these have earnings this week, which being a reason to not short it. We really have to see will earnings save the FANG and save the market. Perhaps more concerning are my summer solstice leaders, which were 50 leading stocks on September 2nd. They have rolled over. They've broken below the 50. Now, will that support turn into resistance? And do we go down here to 190, in which case we're in deep caca if you have a long portfolio, or is it just setting up for a bounce? But right now, all you can do is say, is it failed at the 50-day SMA, which is weak. So I looked at my trading universe, which is like $5 and $250,000. And there's about 2,700 stocks. And isn't it interesting, or 2,300, that right now 53% of the stocks are in a bear market, more than 20% below. So if you're feeling a bigger correction than the 7-8% that's in the market right now, welcome to my world, because the market is sold off in individual stocks much greater. In fact, less than 1% are within 1% of their highs. 5.5% are within 5%. 11.3 are within 10%. So 88.69% of stocks in this market are more than 10% down. Know your news and earnings from a news week. Look for the red dots: new home sales, petroleum numbers, durable goods, trades, jobless claims, and GDP. So certainly a medium, at least, news week. Lots of Fed heads speaking, which isn't always good. We'll talk about the earnings in a second, but it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. This is part of the list for this week. If earnings are positive and strong and surprise to the upside, it will reverse this downtrend. If earnings blow up, look out below. So we start the week on Monday morning with Halliburton. That's a big one. We've got TD Ameritrade, Logitech on Monday afternoon. On Tuesday, got Cat, McDonald's, 3M, Biogen, United Technologies before the market. After the market, Illumina, Capital Markets, Edwards Life Sciences. Wednesday, got AT&T, Boeing, UPS. You got AMD, Microsoft, Visa, and Align Technology. You got GE on Thursday, Nokia, Southwest, Altria. And then I get a little bit excited because we got Amazon after the close. And I haven't decided what I'm going to do with my Amazon position. I've still got a pretty significant position. And to roll the puts another week is going to be expensive. Thursday morning, we've got some more with Moody's, Charter, Phillips 66. So this is a huge week for earnings. So my thoughts, we're oversold, but this week seemed like a pause compared to the prior weeks as far as how much my portfolio got nicked. There's been a lack of synchronization, which has made it tough to play. What I mean is, like Friday, the diamonds were up, everything else was down. Well, if you're short the entire market, you want the whole market to go down. You don't want your sector that you're short on to be up. Most indices, except for the Russell, bouncing along the 200, while sell-off in the NASDAQ matches pullbacks from January, February, March, April. I'll show you that. My bottoms-up review yielded a few potential buys and numerous shorts, especially in the NASDAQ 100. And the market feels like it's going to end this pullback, but we may see more weakness early in the week until potential rebound driven by large cap tech earnings. Nothing would make me happier for it to open up minus 500 points on Monday morning, let me close out my shorts and let it rally from there. I don't know. I can dream, can't I? And here's a couple of interesting tidbits. Here is a list of the S&P corrections greater than 5% since the 2009 low. There have been many of them. They have declined as much as 21.6% between May and October of 2011. They have lasted 150, as long as 155 days. Where do we sit? We are 20 days since September 21st. Average is 41 with a median of 26. We have corrected off the highs. We moved up a little bit, 8.4%, or 7.8, which is right below the median and the average. The VIX is up to 2884, which is below the median and the average peak. And you could see that the Hindis matched up with these corrections. There was an earlier Hindi in 2018. It matched up with a NASDAQ pullback. And of interest, 2017 was a gimme year. It was one of the only years since here. We had 9, 10, 11, 12, 13, 14, 15, 16, 18, but we didn't get at least one correction over 5%. So by this token, maybe we've got a little bit ways to go, but it's certainly nothing unusual. And after every one of these, the markets hit new highs. Is 3 times the charge for the charm for the NASDAQ. These are 3 pullbacks in 2018. The first one, 886 points, 11.8% over 10 days. The second one, very similar, 846 points, 11.1%, 13 days. Now, what's interesting is this one's taken on a little bit longer. It's down 854 points from the highs and 10.5%, but 29 days. So 3 corrections, all 3 almost the same. If I brought it out to the S&P 1500 chart with my multiple moving averages, I add the Hindenburgs up here, the weekly bongo, the bingo, so multiple moving averages, the MACD and kahunas and Eurekas, which we don't have. And what do I see? We're still well above the bands. This was the low right here. Our histogram is turned negative, so that's a little bit concerning. But this is still a stay long chart. My long-term chart says bull. So my typical agenda. Now, excuse the shameless plug, but I'm going to plug one more thing and then go on and look at some more things. Those that have been with me for a long time know I do this for free. What you may or may not realize is the amount of work that it does to get ready for these weekly events. One way that you can show appreciation is participating in my live meetings. I know that in the later years, even Ian had a difficult time filling his live meetings as life gets in the way. The money is an issue for some, and the travel, etc. So I'm going to make it easy on you. If you want to show your appreciation for these programs, if you want to give me the encouragement to keep doing these things and doing, if you like what I do, and I'm sure you like the fact that it's free, then come to my meeting. If you can't come live because life gets in the way, then sign up and participate online during the pre and post and get all the materials from the weekly. If I get a huge number of online onlys, I'll live stream it, but I'm not promising that. We're not seeing that type of interest this year. But again, many of you watch these weekly. I never ask anything for you. You want to demonstrate your thanks. Sign up for the meeting. You'll get your money's worth. And it really shows me that what I'm doing is worth it for you all. Because like I said, it's a hell of a lot of work for me. And I know life gets in the ways. My life gets in the way of things as well. I like to often go into TradeStation and I go into my market force and divergences. Let's just look at the E-mini and get a sense of what the market's doing. I do this following analysis on a nightly basis of each of the major indices: gold, oil, dollar, silver, VIX. And what I look at is 6 points on these slides. To the left, we have a daily. Up top is a weekly, and then on the right bottom is a monthly. The arrows are point number 1. Am I in a person buy or sell signal? Daily buy, weekly sell, monthly buy. So long-term, strong, Some intermediate weakness, but maybe turning around. Number 2, what's the color of the paint bar? A green paint bar is the most bullish. It says I can be long or hold. A red paint bar is bearish. I should be selling or holding. And a blue one is neutral. We're neutral on the daily and on the monthly, and we got a red bar on the weekly. So clearly there's some intermediate weakness. The third thing I look at is where am I within the envelope? And we knew over the last couple of days that we're not going to live outside the elder envelope for long, and we've moved back in. The fourth thing is I look for these little red dots, which are signs of MACD divergence. And even on the weekly, we've now burned off those dots. The fifth thing I look at, where is my high jump bar? When I see it at 100, I know I'm coming down. When I get to 0, I expect a bounce as well, and we were 0 back here as well. There it is. So I look at the S&P. I see this, which makes me encouraged, but it's still a weak chart. I always forget to set my colors, so let me set my color here. Or I can try. Are you going to not cooperate? Well, why are you doing that to me? It would be the first time the trade station and I were not getting along. All right, well, I'm not going to go further on the trade station because it's not cooperating. All right, so let's open up HGSI. Let's take a look at strength or weakness in the market. If you think I'm going to show you a list of great stocks to buy and bull, 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 go, 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 go find Dennis Gartman because you're not going to hear it from me. We're going to bounce. I'm sure we're going to bounce eventually, but I'm not sure which day or when. So let's start with market analysis user groups, major markets plus, hit the warehouse view and change it to a top-down view, and let's take a look at some of the major markets. All right, now that I've got this to actually work, just very quickly back to trade station. You see the NASDAQ still in a sell signal. The Dow is in a buy signal, and the mid caps are in a buy signal. So we've got some neutral, not neutral, but we got some mixed signals on the major markets. The dollar popped a lot at the end of the week. It's still in a sell signal, but I bet it's going to trigger a buy signal very quickly. We'll look at the major sectors, but we'll look at it in HGSI. So if you look at where the strength in the market is here, make sure I sort by raw view. When I see utilities, treasuries, gold, the dollar, silver on top, I know it's not a great time to be long stocks. When I see the mid caps, the small caps, the semiconductors, and the NASDAQ on the bottom, I know it's not a good time to be a growth stock investor. So it's very quickly, let's take a look at the markets. Again, I know we look at them several times, but believe me, right now, your financial success or failure is much more related to what the markets are than any specific stock name that I can give you. This is the S&P. As I pointed out, it's bouncing around the 200. We had a bunch of kahunas. This is a eureka in light green. This is when I'm going to know that it's okay to go long again. We haven't had a eureka in quite some time. I don't know why the phoenixes are not showing up there. So let me just look at this real quickly. So eureka I'm calculating here in the NYSE, and the phoenix I'm calculating on the NYSE. Okay. All right. The phoenix is usually what will fire and it's sort of a follow through day to the downside. Notice how we drop below 0 on the high jump bar. And again, typically this is when you start to see the market start to recover. So do I think we got a bounce coming? Absolutely. Am I convinced it doesn't happen after a big down morning on Monday? Nope. Already talked about how that'll impact on me. Dow Jones Industrials, a lot like the S&P, moved up off the 200. Couple of kahunas. Again, the same thing. Got to that low jump bar, which I've been studying. as a potential buy signal. Maybe we'll talk about it at my live meeting. The NASDAQ composite, a little bit weaker, still bouncing around its 200. Again, got to that point on the low jump bar. And then the weakest of the weakest has been the Russell. And, hard to see anything positive on that chart. And then we talked about the dollar starting to move up. The VIX not spiking by any means, but having moved up considerably from where it's been, come down here from, I think, was it 28.8? 28.8 high. And then if the dollar strengthens, you expect gold and silver to be falling, and they're not. Here's gold, gold miners, and silver all looking about the same. Silver a little bit weaker. And I think the reason they're not falling is because it's a destination of a safe haven. I like to look at industry groups to get a sense of where the market's going. So let's just quickly look at that. And then let's look at 2-day up, and we had 17 to the upside. On a 5-day up, we only have 15 groups. Contrast that to a 5-day down, where I have 74. And since most of them are 5-day down, I think the way it's set up, they won't show up on a 2-day down unless it's a new thing. You only got 2 of them have new 2-day downs. So the markets are heavily to the downside over the intermediate and longer term. So let's look. We have telecom, IT, utilities, household products, packaged food, REITs, utilities, tobacco, food and drug, more utilities, mining. These are very defensive sectors. They're up there perhaps less because they've got great technicals, but more because they're what goes up on days and weeks of volatility. Telecom carriers, is probably a couple in here to look at. AT&T, I mean, clearly in a downtrend, can't get above and stay above its 200-day moving average. Off the lows, why do people like AT&T? Because it pays a 6% dividend. If market is weak, AT&T will probably move up, and you can see the strength of the underlying industry group. CenturyLink, actually a much better chart off the lows of 13. This is one that pays a huge dividend, 9.8%. There's often question about whether or not it has the revenue and earnings power to pay that dividend. It has a new CEO that basically assured people that the dividend will be paid, and that caused it to pop up here. It looks like at a good buy point, a pocket pivot, Kahuna mobile breakout, and again, pays a 9.8% dividend. Verizon's another one that looks interesting here, high base. Kahuna's pocket pivots, mobile breakout from a squeeze, pays a 4.4%, has earnings per share greater, almost double the multiple. Those were the ones that I liked. And then NIHD is a small stock, 6.3%. I used to think these guys had the cell phone towers. Is that who these guys are? Oh, they're the Nextel, so it's a different company. Okay. So mobile breakout from a squeeze, Bible gap up, does not pay a dividend. It's a pretty looking chart. It's probably one of the most bullish charts for uptrend, pullback to support and breakout that I saw, but it's a cheap stock, and I don't know much about the fundamentals. So no question in telecom, carriers are some interesting things. IT services, a few are above its index, but let's see what we got here. Don't know anything about it. This is probably a takeout or something, or maybe great earnings, but from 2.5 to 8.5, that's interesting in one day. It's more from the web, FinViz. You'd have to know something to have been in this stock, in my opinion, because it was doing nothing for a long time. All right, so it's a biotech that had positive news on cystic fibrosis, and then it came back down 22%. Lottery tickets, remember the lottery ticket for that Powerball, whatever it is, You have a better chance of being president or starting in the NBA and winning. Accenture, I don't see why this is a great looking stock. And by the way, that if this is true on what the news is, this is an IT services and needs to be placed, George, in the appropriate directory. Accenture breaking down, had a positive day on Friday on volume, so it made the list here, but it's broken below the 200. I would not be interested. Xerox, no, and here's the index of the group. This is probably a fake news, and this group made it because of the one that shouldn't be there. Utilities, I mean, Duke actually looked good. I'll be the first to admit that if I'm a utility guy, maybe I buy some Duke. Why? Because it's breaking out here, mobile breakout from a squeeze pocket pivot, and a Kahuna pays a 4.5% dividend. Excellence the same. Southern further down in AEP, the same. So clearly, some dividend payers, there's a move towards utilities despite the rising interest rates because of safety. Household products, these are the ultimate and safe havens, consumer staples. These are not rah growth stocks, but what they are stocks like Procter & Gamble, names that are not going to go away. Procter & Gamble is coming off 72s, it's up 16, so it's up almost 20 or over 20%. And notice a Bible gap up on Friday. Pocket pivot in Kahuna pays a 3.3% dividend. Colgate Palmolive down, and it doesn't look very good at all, but pays 2.6. Clorox, nice move, breaking out to recent highs. Mobile breakout from a squeeze pays 2.5%. Unilever down in its pattern pays 2.8. Staples are defensive. I think that's the words here. Packaged food, another word for defensive. Kraft Heinz. Way down in its pattern, moving up. Kahuna's pocket pivots, mobile breakout from a squeeze. I think the most important thing is 4.3% dividend, and maybe you say, hey, it's done going down. Double bottom, triple bottom, at least. Probably is done going down. Got a nice dividend of 4.3%. Mondelez, 2.5%. McCormick and Company, now this is a beautiful chart. It's gone far. The high jump is spiking. The multiples don't make sense with that earnings per share growth. Clearly a leader in the market, too rich for my taste based upon growth and multiple. Kellogg, kind of flatlining, 3.1% dividend. So except for McCormick and Company, a lot of defensive plays. Entertainment content, Walt Disney up 5% over the last 5 days. That's clear strong. And let's see what it looks like. It's breaking out to, at least 1 year highs. Mobile breakout from a squeeze, pocket pivot, Kahuna, everything is green. Good earnings short term. They weaken 1.4% dividend. CBS Corp, kind of sideways for a long period of time, 1.3%. Discovery, another nice looking chart. Broke out back here in June. It had a nice run up. Does not pay a dividend on Discovery A. AMC Networks, not so much. Here's Discovery Communication as well. This one also does not pay a dividend. So we're seeing, I'm not seeing a whole lot that says buy. I'm seeing some things that are defensive that look attractive. Here's some REITs. Again, why are they up? If interest rates are going, are they defensive because of their dividend? American Tower, sideways, break out above the 50 with a Kahuna, 2.1%. The retailers actually showed some strength this week. Here's Simon, pulled back, had a pocket pivot, mobile breakout from a squeeze, 4.6. Weyerhaeuser, used to be a paper company, now it's a REIT, pulled back pretty hard, 4.8%. Public Storage, pulled back down to 200, 4%. HCP, sideways, 5.6%. Welltower, sideways, 5.4%. Is there a story here? Is this about dividends, telecoms dividends, utilities dividends, household product dividends, REIT dividends? Maybe. Take a look at diversified banks. So my bank that I own is Bank of America. This is a preferred shares of Bank of America. And over the last couple of weeks, it's been hard to own Bank of America. But this is one of those lottery tickets that worked out. in that those of us that had any capital left in late 2008, 2009 had the opportunity of buying Bank of America at about $6 a share. So those are things you put away for your grandkids' college education. You never want to sell them and pay capital gains tax. So I hold on to some things long term. This is pulled back in the 28 and a half range. It's got earnings per share growth that's continuing. I think banks go higher, especially if rates go higher. So I'm holding on to my Bank of America. Lots of different preferred settings, shares. So not a lot to get excited about. I think you would agree. Let's take a look at spiders. And let's just look at each of these right now. And let's rank them just by top down. Let's do them alphabetical. So we know what the S&P looks like. We've already looked at it. But we'll start with the spiders, which is the parent. Pull down to the 200. Materials, much weaker. Sideways, big breakout. There's the moving averages coming together here and inverting. Extremely weak on materials. Energy sector, breaking down here. Financials, breaking down, going sideways. Industrials, broken down. Now, is it kind of at a position where maybe it's time for it to bounce? And you can say that about most things in the market, I think, right now. Getting close. Technology, looks like the market itself, all right? Bouncing around the 200-day. Consumer staples, breaking out. No surprise, they should be leading now. And notice on an ETF, a global breakout from a squeeze, a pocket pivot, and a kahuna. Utilities, also breaking out. And healthcare, which has been positive, and certainly when you look at how high above the 200-day it is, you feel good, but it's off its highs considerably. Discretionary, just breaking down, kind of looks like that FANG chart, breaking down below the 200. And I don't think George has put the new one in. Is it XOC? All right. Now, there's a few things that I like to look at. So semiconductors are important to me. This is SMH. And it continues to be broken down much more than technology was. Banks, 3X on the banks, the FAS, also looks pretty bad. XMLF, which is another bank ETF, equally as bad. All right. IBB, biotech, LABU. Look at how LABU fell. So here's a stock, biotech, and I'm a biotech fan, but I've been out of it for a while. Not that I'm smart, I just thought that Trump was going to pull something off that was going to hurt the industry. 46.8% since the June highs. Hard to make money when biotech's down 50%. We looked at utilities were strong, as were staples. Let's look at the FANG stocks because I know they're widely held, and every once in a while people give me a request to look at some of the widely held stocks. Google, consolidating below the 200. Not horrible, but not screaming to be bought. Amazon, Amazon's pulling back. Does it run to the 1650 range? It's got earnings this week. It could pop. We'll get above the 50. Amazon is not the worst looking of the stocks, but it's clearly in a area of indecision. Now, if you own Amazon, and I own Amazon, let me make you nervous. %50 retracement. That didn't work right. Let me try that again. From where it broke out to its peak, 50% retracement line is 1500. The 38% retracement is 1650, sitting right about where that 200-day moving average is. That's my downside target for Amazon. I don't know which way Amazon's going to go, but I think Amazon is risky right here. This is my largest position. I've got puts on it. Apple, probably the strongest of the canaries, sideways on the 50. A little bit of momentum will take that higher. It's got an iPad and a Mac event coming up. Baidu, pretty ugly. Priceline, pretty ugly. Facebook, pretty ugly. Netflix had showed some strength, pulled back down to the 200. You know, Netflix has great earnings report. First quarter typically just came off of good earnings, and it popped on good earnings and came right back down. It'll be interesting to see if Netflix can move up from here. A lot of people see Netflix coming back and retesting the 270, 275 area before the last year's run started. And Tesla, I can't trade that. So canaries look fairly weak and fairly awful. Now, a couple things. Let me do a couple things that people usually ask me about afterwards. Let's look at some of these stocks with upcoming earnings and see if there's any signals we can see. And I'll use magenta. So let's look at Amazon, Microsoft, and Intel and Chipotle. Amazon, Microsoft, Intel, and Chipotle. All right, so we'll start with Amazon. The candlesticks are candlesticks, and it only shows year to date, or May 2018 to date. The green line represents a 5-year seasonality. The yellow is 10 years. When I see they match up pretty good, that makes me feel even better about seasonality. This is a linear regression channel, and clearly if I go back to September, we're in a downtrend. So let's just look at a very tight area, and still in a downtrend. Here's where earnings come out, and over here it tells me if I buy on October 25th and sell on December 5th, I'm right 7 out of 10 times with an average return of 12.9%. And when I'm wrong, I'm down 3.5%. So there's a risk reward there that's fairly positive. Now, the problem is we're in a downtrend. You can see this green bar here, which is the strong seasonality 7 out of 10 that we would see after earnings. So Amazon has a habit, though, of gapping up and then crapping. So I am likely to buy puts on my positions and then finance them by selling some calls and puts way out of the money with some cheap protection beyond that so I don't lose my shirt or my margin. So Amazon looks bullish going from an earnings perspective and seasonality, but doesn't look so good from a chart pattern. Now, just for completeness sake, let me look at Magenta Trader as well. Usually they agree. Magenta Trader has this variable period thing on it that I like. And I subscribe to each of the 3 big ones, and I use them the way I'm using them right now. I don't always talk about them on this because I usually don't have time because there's too many things to look at in a good market. Nice thing about a bad market is I got time to do things like look at sectors and ETFs. So if I put the variable scanner on, you can see you don't have the big positives until February in Amazon. And from where we are right now, if you look at the 30-day scanner from right now, it's up, hold on a sec, 7 out of 10 years, average is 16.7%. But there have been a couple of pretty big drawdowns on Amazon. Hold on, let me just redo that. So I just line up here. And from earnings, it's up 7 out of 10 years, 16%. All right, so Amazon is a positive, but don't like the current chart pattern. Microsoft, which has been, if anything, has been relatively, comparatively going sideways, but also in a downtrend. 8 out of 10 years, 8.5% on the up years, 3 of the down years. So Microsoft has positive seasonality. Intel, another stock that has been in a bit of a sell-off, has a 7 out of 10 positive seasonality. And then Chipotle is one that in a downtrend but has negative seasonality here. 7 out of 10 to the downside with an average downside of 14%. So I don't remember. Let me go back to my seasonality chart and see if there's anything that stood out. And I do this one in EdgeRater. Everything I show you on these reports are things that we'll do during my live meetings. All right, so here's a seasonality report. My highest scoring seasonality play for this coming week was Generac, 8 out of 8 up, average 13%. SIVB Financials is up 85% of the time, averaging at 10%. To the downside, my big loser was Paratech, down 8 out of 9, average of 15%. And what you can see here is the stocks that met my criteria. I'm looking at 1 month plays, average return over 5%, up or down, how many years they were correct. CBOE, global markets, up 8 out of 8 years, average return is 6%. And then what I basically do is figure out the average return and then what percentage of the time there's a win. And then I multiply the two together to get a score. And the highest score you could see was generic. All right. Let's go back and I'll show you the stocks that interested me for this week. But let me say it one more time. This is all about the market. When the market moves, I'll be running my boxes and looking at high box stocks with good earnings and revenue because they typically are the leaders out of a market pullback. If you don't know what I'm talking about with boxes, go back to the thing I did on that Thursday, October 11th, where I showed you how to make the boxes. I pick stocks to watch, but mostly so I get a sense of when that market turns. If I look at the sectors that they were in, you could see I've got a bunch of REITs and telecom carriers and utilities. Those were the best of the best. Why? Because those were the industry groups that were leading. I'll show you a couple of things that I thought were interesting. Immunomedics. Here is a biotech that pulled down to support. It's had a couple of kahunas. Volume is increasing. Out of a squeeze, it looks like it's breaking out. That's one that I liked. It has a little bit of revenue but does not make money. Renewable energy I picked a couple weeks ago. It had a nice run. Pullback on Friday, I don't think it's necessarily broken. Great earnings per share growth compared to multiple. First, Bancorp is an inexpensive bank in an uptrend sideways. Kahuna mobile breakout from a squeeze. I wish I could tell you that every one of the stocks on my list looked this good. Mosaic, nice uptrend going sideways, waiting for it to break out. But this is the land of tough to find good stocks. And many of these I've already showed you. Now, I often forget to show you the stocks that I'm thinking about going short on. Now, again, I'm not going short when I think the market's going to bounce, but I am going to take a list of potential short plays and put them in my radar screen and watch them to see what the market's going to do. Here are my potential shorts for this week. And let's just look at them and see if we see a theme, because I never talk about to the short side, and then I'm going to say goodbye. Abiomed broke the 50, failed to the 50, had a big down day on Friday with the Mobo breakdown. My target here is probably not enough at the 200-day moving average. And let's look at where we are. We closed at 362. The 200 is at 344, $18. It's a 5 to 6%. And on a lot of these, if I take them, I'm going to look for 3% and get out. That's Abiomed. Adobe broke down despite good earnings, traded up to the 50. That's when you short it. When it fails the 50, again, target down to the 200. Align Technology broke through the 50, couldn't get close. Right now, I probably wouldn't short it because it's sitting on the 200-day moving average. But if it breaks down below the 200-day moving average, I'm going to start to wonder when I've taken one of the stocks with the biggest uptrends of the last market, and when am I in a, that's not what I wanted, my bad. When does I turn this into a new trend, downtrend? I'd be taking profits. AMD failed at the 50, next target's the 200. Amazon, I already talked about. Arista broke through everything. It's in a downtrend now. It's going to continue to trade down and then trade up and trade down. That's until proven otherwise, it's in a downtrend. Domino's Pizza bounced on the 50, more of a watch here than actively do something. Fleet Core failed at the 50, 200, couldn't stay above it, dropped down. That's a very shortable looking position. IAC7 Interactive failed, could not get above it. The 50, coming down to the 200. Intuitive Surgical failed the 50, failed 3 times to get back above. Next stock to 200. This is one that I kind of wonder if you don't get all the way down to 400. Lululemon, great run up. Broke the 50, couldn't get back above it. Next stop after an ISO failure is 200-day. Marathon Petroleum broke the 200. New Relic broke the 200. ServiceNow, which has been strong, failed to get back above the 50. Probably would wait until it breaks the 200 before I would consider shorting it. These have been the big leaders in the market, and they've rolled over. Novacure, one of my big wins, is now broken down below the 50. NVIDIA, I knew it was time to short when my son called me 3 days ago and said, what about buying some out of the money calls because he's sure it's going to double. It broke down here. Palo Alto Networks, Dave & Buster's, Regeneron, not yet. Ross Stores breaking down below the 50 if it can't get above it quickly. Stars, not yet. Okay. TX breaking the 50. Better get above quickly, or with that Mobo breakdown and a squeeze, kahuna to the downside and pocket pivot. If I flip that around, I think it's going higher, so that's going lower. My big win tandem, of course, there's profit taking up here. Failed to get back above the 50. I'm out of the position now. Look to get back in. Trade desk broke through the 50, couldn't get back above it. So a lot of weak stocks. So what do? I'm going to sit on my hands probably until 9:30, watch and see what the market's doing. If I see the market's down 400 or 500 points, I'll be licking my chops because I'm set up for that. And I will be sitting on my hands, maybe putting in some really crazy bids on some stocks that I might want to own if I can get them real cheap. I'm going to take my stops off if the market's down 500 because when I have stops on existing positions, they always get stopped out at the low of the day and then the market recovers. I'm going to be logged into my platform so I don't have a hard time getting in, and I'm going to be excited to see what the market does. If the market opens up 30, 40, 50 points, which is also possible, I'll play that as well. But I don't know what the market's going to do on Monday. My guess is we reverse either Monday or later in the week. Couple other things. In TradeStation, one of the great things that you could do is you can stick your stocks, here's my buys, for example, and my shorts into a screen like this, and I could be watching for my Q signals, my adaptation of some of the HGSI indicators, pocket pivots, Bible gap ups, earnings dates. I could look for time to earnings, and I could see when my earnings are coming in on the stocks I'm looking at buying. I probably wouldn't want to buy right before earnings unless I had a really super edge, which I don't think I have. The Bible gap ups, like the one that came in on Procter & Gamble, show up early in the day. If you come to my meeting, you will get, or if you register, all of these indicators at no charge. And I have them for Thinkorswim as well. So lastly, just a couple more. So when I watch my radar screen during the day, I look for blinking signals that tell me something is fired during the day. And I also have my favorite John Person signals here as well, firing and giving me a clue as to what's going on. And lastly, one more shameless plug before I say goodbye. If you want to support these programs, if these are things you like, my ask is simple. Please sign up when you come live or don't come live for my upcoming event on November 28th. I guarantee you for $500 you'll get huge value even if I don't feed you. And if you sign up and do it as a offsite, you'll get all the materials, you'll get videos of all the presentations, and if I have enough people, I'll live stream it, but we're nowhere close to that right now. Goodbye, everybody, and have a great week. Be careful, and waiting for the bounce. Goodbye.